Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 400 and something, 418. That's what it is. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
And today, life insurance litigation.
Really bad ideas with life insurance. Not that whole life insurance is a bad idea, by the way. Just I want to get that in there.
There are certain applications that are horrible ideas, and we're going to talk about them.
You know, it's funny because we haven't actually talked about these horrible ideas in a long time.
We haven't. It's not the first time that we've touched on this subject, but we took a little break from this.
Yeah, but the life insurance gods giveth. Sadly.
They do.
We don't mean to make light of this situation because it's not good, but...
It's not. It's not, and you're going to sense a certain amount of arrogance in this because this show is brought to you by the phrase "I told you so." Because as I mentioned, we've brought this subject up, and now we've got proof that there's people who are unhappy.
This is a little more intricate and complex than things we've talked about in the past, but the concept's still the same.
Yeah, it takes the things that we talked about in the past and said, hey, you shouldn't do it. And it's like, well, let's do it anyway and do it even worse than they said.
That's right. Well, if you do a good job at doing a bad job, you obfuscate all the bad things, and then it's not until much later that people realized it was a bad thing. So therein lies the lawsuit.
True and super, super sad statement.
Yep.
So very late last year, there was a lawsuit filed naming numerous defendants.
Yep. And we're not going to talk about any of them specifically because that's not important.
They're not important. There is an insurance company that we do have a relationship with. They're going to probably not love the fact that we're talking about this, but they'll get over it. So this lawsuit alleges that a certain representative of said insurance company worked through a very complex pattern of companies and iterations and schemes to convince people that they needed to buy life insurance, and they needed to do a lot of really complicated things with that life insurance in order to, I guess, save taxes.
Yes.
None of which apparently
it's basically
worked.
A tax scheme, which is what.
Yep.
Why this all came to fruition, really. Am I correct on that?
Yeah.
I had to read through pages and pages of legal documents here, so.
100 plus?
Yeah.
This complaint is huge.
Yeah.
So.
Which gives you some idea of the complexity of what was happening.
Yeah, it's huge because it's complex. It's huge because there's a lot of plaintiffs.
Yeah.
So there's a detailing of all those situations, and this is, as you mentioned earlier, very sad. And the big motivation for bringing it up today is the fact that I don't remember right now when we recorded our first podcast telling people, look, you don't need to overcomplicate life insurance.
Right.
It was very specifically brought up in the context of premium finance, which you will have no hard time believing was definitely a big component of what's going on here with this complaint. Really, what happened to us, to give a little background on that original kind of warning, which, it's probably 10 years old by now. We'd known about premium financing for all of our careers, basically. Yep. And we never really talked about it on the Insurance Pro blog, except to note that, look, there is a world where some people of very high net worth may choose to purchase life insurance with financing if
using
and
OPM,
only if
other people's money.
Yeah. If and only if there is a sufficient enough spread, if you will, between the cost of borrowing and what they will accumulate in value in the policy to make the financing of the purchase of the policy a net cheaper cost to them out of pocket.
Right. Notice we didn't say anything about cash value in that.
Nope, we didn't. They want to buy death benefit, and they want to try and get it on a discount because there is a spread, potentially. And it is especially so when interest rates were really low.
Yeah.
So interest rates are low. The accumulation of cash on certain life insurance products may be strong enough to borrow the money, pay the premium with the borrowed money, and the money that comes out of your pockets, interest payments to service the debt. And you might end up in a situation where you could grow enough cash in the life insurance policy to retire the loan and then keep the remaining policy intact for yourself. And that kind of net benefit is the death benefit that you were seeking.
Right.
That's premium finance in its existence up until, like I said, kind of about 10 years ago.
Yeah.
Then
it was a classic. I've said this before on our podcast, but I don't know that everyone listening has heard it. It's a classic buying dollars at a discount situation. Yep. That's really all it was. That was its original intention. And we have maintained that should still be its intention.
Yeah. Yep.
There's really no, and in most cases, what we have seen, what I guess what I would call the quote unquote correct application of a premium finance life insurance policy was an estate liquidity situation where someone, is doing their estate plan and their attorney / accountant or both says, you got an estate tax problem here.
And keep in mind,
or you just have a liquidity problem in general, because that may not be exclusively estate taxes. It may just be in general, but a high net worth family or individual, and there's you need $40 million of life insurance.
Yep.
To accomplish the things you want to accomplish, and they go, okay. So they go out and they get quotes, and they go, well, it's going to be $500,000 a year, or $800,000 a year,
quite possibly,
or whatever. More. Yeah. Depending on how old the person is and all the other extenuating circumstances in their life. But there's a lot of money out of pocket, and they're like, I don't know if I really want to pay that.
Yep.
And so enter premium finance that says, well, we could do the same thing for you, and through calculations, figure out that your net cost could be lower. I won't even spew numbers because they'd be wrong. But
it's not quite as simple as like the interest is this per year, because the loan balance is going to grow every year. So the actual payment goes up every year.
Right.
But what you're trying to do is get a low enough cost and interest to net out ahead. So from your example with your what was it, $40 million? It's probably not that important. Death benefit, maybe it's $500,000 to $800,000 of premium they'd need to pay.
Right.
Well, there was a time when you could borrow money to pay that premium and probably pay somewhere around 2% for that.
Yeah.
So that's $16,000 per year out of pocket versus $800,000 a year.
Yep.
Out of pocket.
Yep.
That $16,000 can accumulate year over year for a while before you've even totaled 1 year's premium. That's where it was attractive.
Exactly. But it was done for death benefit purposes.
Yes, entirely.
Originally.
The only reason for the cash was to eventually retire the loan.
Right.
And then you would keep the remaining policy intact and you'd have that death benefit.
Right.
And you bought it at a discount.
Right. Yep.
So that was the idea. Now, 10-ish years, actually a little more than 10 years ago, we started to see people out selling premium finance as a way to leverage life insurance as a retirement vehicle.
Yeah.
So
being sold to more what I would call rank and file.
Yep.
Or probably not rank and file, mass affluent.
They had a certain amount of wealth, but they didn't have wealth that made them that put them in a category where premium finance was traditionally indicated.
They weren't ultra high net worth.
Nope. These are people who, if they had an estate tax problem, and remember the estate tax threshold used to be much lower than they are today, it was small. In a lot of cases, they didn't have one.
Right.
So there was no use talking to them about the estate tax.
Right.
And instead, there was a pivot to, hey, did you know you could borrow money?
Sure.
And fund a life insurance policy to accumulate a big retirement nest egg. And you can leverage up the dollars through leverage to leverage the policy and leverage out your retirement. And I hope you guys are catching on the joke that I'm going for here. So that was the pitch.
You get leverage and you get leverage. You're just the Oprah of leverage around here.
Yeah. That was the pitch, though. I mean, it was leverage. That's it's special because it's leverage. And we had a few people, both clients of ours and then prospective people who want to do business with us, come to us and present these other proposals that they had been given to do this.
Yep.
And every time we looked at it and said no. I remember distinctly one who was and is a current client who had been pitched this and sent me the details. And clear as day from that presentation, it's like, well, right, but if you just took the money that you're going to use to finance the loan and just use that to pay premium, it's the same.
Right.
Then you don't have all of the risk of borrowing money and having to pay that off.
Which is a key point to bring in here, because there's another fundamental part of this that, at least in my rudimentary understanding of this case, plays a major role in why the chickens came home to roost here.
Yep.
And that is that most premium finance, I will say every premium finance proposal I've ever seen on the loan side is a variable rate loan.
Yeah. Oh, yeah.
It's not a fixed loan.
No.
So, in other words, if these were 30-year fixed rates at 2%, no problem, probably. But, I mean, I'm saying something ridiculous because it was never going to happen.
Right.
But many times you could get fixed rates for a period for several years on the front end.
Yep.
And then it adjusts to wherever. And everyone knows what's happened to interest rates over the last several years. So.
And not only were these adjustable rate loans, but in order to renew the loan, oftentimes there could be changes in circumstances that the borrower had to satisfy.
Yep.
So, for example, you start one of these premium finance loans. You're paying 2.5% interest per year, and let's say that it renews 3 years later.
Yep.
Interest rates have gone up. And you don't have as much cash accumulation in your policy as was projected.
Yep.
So now the bank says, all right, not only are you going to pay 6%, but you need to post additional collateral before we'll even renew this.
Yep.
And you say, well, I'm not going to do that.
Because there's always a collateral. We didn't even talk about the collateral requirements, but there's always a collateral requirement.
Yep. In the beginning, cash value that you pay, if you pay an $800,000 premium, you're not going to have $800,000 worth of cash value.
Right.
So the difference between what you actually have in cash value and what the loan is going to originate at, that needs to be covered by something, and people post collateral for that. To give you a more quantified example, if you had an $800,000 premium due and you borrowed $800,000, probably in a life insurance policy, one that's well designed for cash accumulation, you're going to have somewhere in the neighborhood of like $560,000 of cash.
Right.
At the end of the first year. There are some policies, some specialized policies out there that would have a little bit more, and those might be a better choice for premium financing. But just speaking in general terms here, $560,000. So you need to come up with another $140,000 to make the bank whole. And so you need $140,000 worth of collateral in order to, or excuse me, $240,000, not $140,000, $240,000 of collateral to make the bank happy.
Right.
And move forward with the deal.
Which is typically money in an account that they assign.
Yes. And again, to the person who's got a need for $40 million of death benefit, they have tens of millions of dollars of assets.
Right.
So they've probably got some assets sitting around that they could post as collateral. They're not that worried about it.
Right.
But to the individual who's got $2 million net worth, who's being told, yeah, borrow $500,000 a year and put it in an indexed universal life insurance policy so that we can lever up your retirement account, they're not going to have as much in terms of assets to post as collateral. They're not going to have as many options as far as good collateral that a bank wants.
Right. And the illustrations that we have seen over the years typically paint a picture where the collateral assignment goes away because the cash value in the policy increases over time. Yes. And so the idea being you're going to post collateral the first couple of years, then the collateral assignment's going to go away because there's enough cash value to make the bank whole if you don't pay or whatever, anything happens. That's...
Yep.
But rising interest rates complicate all of these things.
They do.
This is the side of leverage that people don't like to talk about. So.
Nope. let's do this. I want to get into some of the particulars of what is alleged. Then I do want to return to this subject because we do have some personal experience on that on the topic of what happens when collateral is insufficient and you need to renew terms and such. We've been able to observe from afar.
Yeah.
The frustration, and I want to go through some of these examples first, and then we'll get into some more personal experience. And I want to remind everybody that this is a complaint filed by attorneys. Everything is alleged. So when we talk about this, I'm not saying any of this actually happened. We're talking about what is alleged in the complaint.
Well, you're right, and the thing, however, the thing we do know is that this was an overly complicated scheme.
Yes, that's yes.
And that's why we're talking about this.
Yep.
It's not that premium finance is, I want people to view the individual components of this and think about it objectively. Premium finance is not a bad thing. Insurance companies are not bad. And the other defendant parties in this may or may not, I don't know them we don't know them personally. We don't know anything about them.
Nope.
So, we can't opine about anything about them. But the scheme, when you put it all together, is the issue.
Yes, that is very true. So, pulling some of the examples that come from this, and they're the classic issues that we have warned against, and that we've just spent time setting the stage for. People who went out and bought policies and bought them through premium financing. And there's one allegation here about a plaintiff who ended up accumulating a loan balance of almost $2.7 million.
Mm-hmm.
But cash and collateral, by the time they were set to renew, was a $2.4 million. So
you're saying cash in the policy and plus their collateral was 2.4.
Yep.
But the loan balance is 2.7.
Yep. So at this point, the bank says, we're not going to renew until you post more collateral.
Right.
And they say, we're not going to do that. So the bank says, well, that's fine. We can compel the insurance company to cancel your policy and we'll take its cash, and the collateral that you posted, well, that's ours too.
Right.
And that's kind of the danger. And I know that there are times premium finance is kind of presented by people with a somewhat more flippant sort of approach to it, to say, well, look, if you borrow this money, you're going to accumulate the cash in the life insurance policy. So let's say the loan interest rate goes up and you don't want to make that payment anymore. And you just decide 8 years down the road, this isn't a good deal. I don't want to do it. You'll surrender the cash in the life insurance policy. You'll retire the loan. You'll walk away.
Yep.
That's it. But that's not it. Because in a lot of cases,
if it only totals 2.4 and you owe 2.7, that doesn't really work.
Right. You're going to owe the bank still.
Yeah.
And then any collateral that was posted that is part of getting you to the total of the loan, that's gone. If you end up not carrying or satisfying the loan balance.
Yep. I want to interject and say this is because it's a good time to make this point. This is why the original intention, remember back to my original example, the person who is potentially going to have to pay $800,000 for $40 million of death benefit. Mm-hmm. They didn't opt for premium financing because they couldn't afford the $800,000.
Yes, correct.
So that's the key distinction. So in the original intent of premium financing, these were people that actually could afford those wildly large premiums.
Yep.
They just didn't want to.
Yep.
So in other words, if they got into a situation where 3, 4, 5, 6 years down the road, this was not working and things were upside down and inside out, and they were like, I just want out of this, they had the money.
Yeah.
To bail and keep the life insurance, by the way, because they still had the need for it.
And also, like, things could go upside down and it's not as good a deal, but in a lot of those cases, it's still an okay deal.
Right.
Because in those situations, okay, you paid $100,000 more than you thought you were going to.
Right.
in interest expenses.
Mm-hmm.
But you still saved $1 million out of pocket.
Over what you would have paid.
That's the difference. That when the margins get that thick, things are pretty low risk in terms of falling apart.
Right. As long as you have the money.
When they don't. Yep. It reminds me, there was a couple of years ago, there was an agent who reached out and wanted to pay us for some consulting as far as like policy approach, design, stuff like that. So we did it. And he was telling me that he had written this one case that he thought was a pretty big deal case. And he went to some conference with other insurance agents and he was talking about this case that he's quite proud of. And they all kicked him in the nuts telling him like, you could have premium financed it. Could have been like 5 times the size.
Right.
And he was really stunned by this. And he asked me like, is this true? Like what did I do wrong? And I'm like, I don't think you did anything wrong. I'm not going to tell you that what they're saying isn't factually true. It could be premium financed and that would make the premium much, much larger. You would have made more money. But I don't know that there's any net benefit to the client at that point.
Right.
So I wouldn't have done it if I were in your shoes.
Right.
The other crazy thing that comes from this stuff, and this is just a general planning thing, and keep in mind that all of this alleged life insurance sales stuff was done, as we mentioned already, under the scheme of tax. Yeah,
I was about to say we got to get to that part of it because it's not primarily a premium finance case.
Nope. It's really about, hey, look, you need to know the secrets rich people employ to save taxes.
Right.
And that has been a loved pitch for financial people for years.
And then the premium finance got added to it. That's.
So they just like that and love going down that road. And so the really starts to get complicated quickly. And there's one part of this complaint that is mentioning the fees that got paid to set up an array of crazy things. They total $221,000. And I'm sitting here looking at this going, I don't know this person's particular situation and the complaint doesn't really speak to it that much, but how much were you supposedly saving in taxes to make $221,000 of fees paid? I mean, there's got to be a few years before the break even.
Right.
In most cases.
That's a substantial amount of fees.
Mm-hmm. It's a lot.
Mm-hmm.
And the other super duper sad one is the note that at least one of, and it could be more, and I'm just forgetting. I'm going back to my notes here. One of the plaintiffs here listened to the advice, implemented the plan, ended up getting audited. Is not done with that audit according to the complaint, but had spent to date like $130,000 in legal and accounting fees.
Mm-hmm.
And apparently their accountant estimates that interest and penalties. So we're not talking about the actual tax liability, but interest and penalties, because the IRS audited this and said, yeah, none of this stuff is legitimate. You can't do any of this. Interest and penalties are $570,000.
Yeesh. Which means the tax liability is some multiple of that.
It's bigger than that. Yes.
So what was the tax scheme, or the I don't know if I should use the word scheme. What was the big promise about saving taxes that was the impetus for this whole thing?
You'll pay less.
Do you understand it at all? Because
No.
I tried desperately.
No. And look, we both have a pretty substantial background in the financial system, in the tax system. We're not accountants. I'm not going to pretend like we are.
And we both listen to a lot of pitches like this.
Yeah.
A lot.
And we understand life insurance intimately.
I've listened to a lot of pitches like this where the pitches were like hours long, but I paid attention for the first 8 minutes and was like, now I'm going to doodle because I ain't doing this.
Yep. We're very intimately acquainted with how life insurance works.
Yep.
And we have looked at these sorts of things for years. More than a decade. And every single one of them just doesn't.
They failed the smell test.
Yeah. They don't work. And we have worked with a lot of people over the years.
Yep.
People with a lot of money who now have lots of money sitting in life insurance.
Mm-hmm.
They all got there by doing one simple thing.
Put money
buying
into
a life insurance policy and paying the premium.
Yeah. But this was about using a series of
businesses, LLCs, in some cases
charitable deductions
LLCs.
of some type. Yeah.
Yep.
And then taking that money that was in the LLC and buying life insurance and.
Mm-hmm. And look, I will definitely tell anybody listening that there are things one can do to marginally decrease tax liability. And when you're talking really big numbers, there are times that can be worth the pursuit. But if the numbers you're playing with, and I mean, there are many situations here where this complaint notes that the agent would, who was also acting, I guess, as an accountant auditor of some sort, was putting these plaintiffs' businesses on a financial questionnaire valued at like $20 million. And these people were like, I think I have a personal net worth of like $3 million.
Yeah.
So if that's your personal net worth, I'm going to guess that your cash flow numbers are measured in the hundreds of thousands, maybe million.
Right.
Or $2. And at that point, there's not that many things you can do with US tax code when you get super fancy that make any marginal difference in terms of what you're paying.
Yep.
And believe me, that took me a long time to accept. There's going to be a number of people who hear that and they want to fight about it, but it's not there. It's not worth it. So I remember years ago sitting at a dinner for a certain insurance company with other agents. And there was one guy there who thought he had done some fantastic thing by copying kind of some trust planning that Mitt Romney had done and had come out in the news when he was running for president. And I'm sitting there thinking, and he laments that this stupid client or prospective client of his didn't do it. And I sat there thinking, I think I know the one fundamental problem based on the numbers as you've discussed them. This guy doesn't have anywhere near as much money as Mitt Romney does.
Right.
So it doesn't make sense for him to do it.
Yeah.
For all kinds of reasons. He doesn't save that much money. He doesn't have anywhere near the resources to defend it legally if it gets called into question. So, like, he's not playing in the same sandbox.
Right.
You need to stop telling him he is. I mentioned we have some personal experience. We have clients that against our advice went out and premium financed some things.
Right.
And a number of them, we found out sometime later, are mighty underwhelmed and unpleased with the results.
Yeah.
We even in a couple of cases have had the privilege of talking to friends of those people who were advised by those clients of ours to do the same thing. Some of them did, some of them didn't. A couple who did were very, very, very hesitant to talk to us after they were referred to us because they didn't want any more bad ideas thrown their way.
Yeah.
So
I don't have much to add to that, but yes, it's true. I'm thinking about one situation in particular where a person shared their what am I trying to think of? The in-force illustration from the policy that they used to finance, and it had woefully underperformed.
Yep.
And they were at a period where they were not, by the original illustration, should not have been having to post collateral, and they were continually having to post collateral.
Yep.
And it was causing them, I don't want to say difficulty in that they didn't have the collateral, but it was
major frustration.
It was frustration for them.
Yep.
Because this person operated a business that didn't always have a lot of liquidity.
Uh-huh.
And that was holding up some other things that they wanted to do. That's my recollection. That's been a long time ago, but.
Yep. So there are really simple ways to grow wealth that are tried and true.
Mm-hmm.
They work fantastically. There really aren't that many secrets.
And they're not gray areas.
No, they're not. They're not at all. There really aren't that many secrets that the wealthy are holding from you. There aren't.
I know. That's why I'm laughing. Because it just sounds ridiculous when you say it out loud. I mean, I see so much of that stuff on social media and whatever, and it's always just like eye-rolling to me.
A lot of them are plain as day things. You just don't have enough money to actually make them work.
Right.
And that's that. But the one thing we can tell you is that regular life insurance, whole life or universal life insurance, purchased without a loan and paid consistently is always best, will accumulate cash.
Yep.
That is both tax deferred and accessible in a non-income tax liability way.
Yep.
Works great.
Not a gray area.
Nope. And doesn't need complicated tax planning, doesn't need additional fees paid to somebody to set up, doesn't run any risk of IRS audit.
Right. It's black and white.
We've known a number of people who've amassed a pretty substantial amount of wealth just doing that.
Yep.
And living pretty happy lives. So
no shortcut there.
The next time somebody says, I got a super secret trick the wealthy use to get ahead that I'm going to teach you.
They have to, your antenna should go up if they have to show you flow charts.
Yes. You know, it really is kind of an old business rule. And I know some people think life insurance is complicated. I think it's just, it's new.
Right.
There's terminology that's not familiar.
Right.
Once you get that stuff down, it's pretty easy to understand. And I have never had to explain life insurance to somebody with a 30-page PowerPoint. Never had to do it.
You never had to say, well, we're going to set up this trust over here, and then this LLC, which is going to own this trust and going to own an interest in this LLC, and then, yeah.
Nope. So simple is better. It is for a large number of people.
Yeah. Absolutely.
And in some cases, be thankful that you can do simple things.
Yep.
And get ahead.
That work.
Yep.
Without the complication.
Correct. Okay.
All right.
We drag the horse out from the graveyard, beat it some more. We'll put it back until next time.
Oh, sounds good.
I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.